Hey guys, this is Dave from MortgageGuy.com, and Fannie Mae and Freddie Mac just came out that they're changing what's called LLPAs, okay? And in this video, I'm gonna break this down and answer the bigger question, are mortgage rates getting higher or lower because of this? But before I do, please subscribe to my YouTube channel to keep up with more videos like this. So they recently came out and changed what's called LLPAs, which is loan level price adjustments. And what this is when it comes to mortgage rates, the credit score, the down payment, the property type, if it's a condo or not, those things are technically called hits to the rate or costs. So you're paying a cost for the interest rate. So in theory, it's not making the rates better or worse, it's changing the cost of the rate. Now, that may lead you to take a higher interest rate to avoid paying so much in cost, but that's what those LLPAs are. So I want to break that down first, okay? Now, they came out and announced this change in order to improve the capital or the money that they have to help with lending and really strengthen their ability to lend, okay? And so this is why they made these changes. Now, as you can tell in this chart, there are some areas where they greatly improved and lowered the cost and some areas where they worsened them. So if you look all the way in the bottom right-hand corner, the lower credit scores with the lower down payment, those costs improved. That's helping some home buyers get in using a conventional loan. Remember, this is not for FHA or VA, okay? So that was a benefit. You'll see some red areas there in the middle where they're in a higher credit score tier, and that's causing them to have, and depending on down payment, having a higher cost for that, okay? They've also increased and added tiers for these rate adjustments. Before, any credit over a 740 was excellent, right? Now you're gonna see tiers over a 740 and over a 780. That's a complete game changer, okay? Because now if you have a 740 versus a 780, you're gonna have a different cost for those rates. So that's important to remember. For as long as I've been doing it, if you've been over a 740, that was considered excellent, the best of the best. Now it's gonna be a 780, okay? They've also made some other adjustments when it comes to condos, first and second mortgages. And so it's not as easy to say that universally something is better or worse without knowing the exact scenario of the client. So be careful if you hear a loan officer saying for sure they got better or for sure they got worse, okay? Now, on top of all this, the one that greatly concerns me the most, and it's something you're gonna wanna monitor, is they've added an adjustment for debt ratios over 40%. And this was never the case before. If your debt ratio was 20% or 47%, your interest rate was the same. Now with a higher debt to income ratio, you're going to have a higher cost of rate, okay? Something to think about. Now, here's the additional layers there. One, who's determining that? Not you as the consumer, but the mortgage company, right? So are they being conservative on your income? Are they being overly aggressive on your income? Okay. Some of these scenarios wouldn't be really known until it's in underwriting and your loan's approved. So what happens if your debt ratio was a 39 when you were pre-approved and your rate was this? Then it goes into underwriting and you need flood insurance. And your payment goes up, your debt ratio goes up. And now the cost of that rate is higher. What's gonna happen? My concern there is that some lenders, especially the bigger ones that aren't paying attention to the file very well, are going to come back and say, hey, unfortunately, your debt ratio is higher and now your cost is this. That's completely unacceptable. My team and I are going to actually address this up front. And if we think it's a possibility and or if it comes up later on, we're going to eat that cost for the client. We're not going to allow a customer service issue over something like this, no matter what the guidelines are, all right? It's unacceptable to come back to a client 2 weeks into their contract and say, hey, sorry, you're going to need an extra $1,000 because we were over aggressive or under aggressive when pre-approving you. It's completely unacceptable, and I'm not going to allow that to happen. But I do think that's something to monitor depending on how other lenders handle it. And if you hear that happening, it's 100% because of that. Oh, hey, our costs went up because of their debt ratio. It's this example, okay? So this is the breakdown of LLPAs and what to know with those changes going into effect. Even though it's going into May is when they're going to really put these into effect for it, lenders are going to start to include these in advance of that, most likely in March, okay? So if you have a client who's on the fence and they're getting close to that date, right, maybe going under contract, it's something to really pay attention to. Hey, is it going to get better or worse if we lock in the rate and know the specifics? All right? If you find my videos helpful, I would love to be your lender. Subscribe to my YouTube channel and stick around for the next video. I think you'll like it. Thanks, guys.